Very good morning to you all. Today I'm going to solve a problem based on valuation of goodwill, that too the method called as adjusted past year profits, adjusted profits. So in adjusted profits, the very important notes that we have to remember or we need to keep it in mind, those points are: the first one is, if capital expenditure is treated as revenue expenditure, how to treat this one in the adjusted profits. If capital expenditure is wrongly treated as revenue expenditure, how it has to be recorrected in the valuation of goodwill. We all know what is the meaning of capital expenditure. Capital expenditure, these are the investments made on long-term assets. These are the investments made for purchase of fixed assets. For example, purchase of land, building, purchase of furniture, purchase of machinery. So whatever the amount that we have invested to purchase the fixed assets, we call it as capital expenditure. On the other hand, we have one more terminology, that is revenue expenditure. Revenue expenditures are the short-term expenses of the business. Short-term expenses or the day-to-day expenses. Example, salary paid to the employees, electricity charges paid, advertisement expenses paid, and general expenses, administration expenses, postage and telegram, etc., etc., etc. All these short-term expenses are recorded on the profit and loss account on the debit side. These are all indirect expenses. What you need to remember is that revenue expenditures are the short-term expenses. As you can see here, if capital expenditure is treated as revenue expenses, usually capital expenses has to be recorded on the asset side of the balance sheet, but here they have recorded as expenses and it is recorded on the debit side of the profit and loss account. How it has to be corrected? Let us look into the first step, that is how it will affect the profits. If capital expenditure is treated as revenue expenses, how it will affect the profits of the company. I have taken an example. Purchase of land and building, rupees 1 lakh. This is an example. Where exactly it has to be recorded? Purchase of land and building. It has to be recorded in the asset side of the balance sheet, but it has wrongly recorded in the profit and loss account on the debit side. This is what the meaning of capital expenditure is treated as revenue expenses. So let us look into the impact of this one. Here, profit and loss account, I have assumed some values here. The gross profit is 10 lakh. I have considered few examples here. Salary 1 lakh, general expenses 1 lakh, advertisement 50,000, land and building rupees 1 lakh. So here this land and building is treated as revenue expenditure. So profitability will decline. The profitability is rupees 6,50,000. If I don't consider land and building in the profit and loss account, my profit would be 7,50,000. So wrongly it has recorded as a revenue expenditure. The impact will result into reduction in the profitability. As you can see here, if I don't consider land and building in the profitability, my profitability is rupees 7,50,000. If I consider this one, it will be 6,50,000. So capital expenditure is treated as revenue expenditure. It will reduce my net profits. So how it has to be corrected? So it has to be made reverse, that it has to be added to the net profit to get the right answer. In valuation of goodwill, all capital expenditure which is treated as revenue expenses, it has to be added to the net profit so that we can get the original profit that we have earned. I hope you have understood. And I think you have got the point. The next point, that is, if closing stock is overvalued, what has to be done? If closing stock is overvalued, how it has to be treated in valuation of goodwill. Adjusted profits. If clothing stock is overvalued, it results into increase in the profits. So it has to be decreased. So let me give an example for this one. How it will affect the profitability and it will increase the net profit. So to get the original profit, we have to deduct this one from the net profit again. So let us look into this one. How overvaluation, I mean to say overvaluation means increase in the value, showing more value than the real value. Let me give an example and I will show you how it will affect the profitability of the company. Closing stock is overvalued by rupees 20,000. Let me draw a trading account here. Trading account. Debit, credit. I am just assuming sales as 10 lakh. To purchases 1 lakh. Wages 50,000. Opening stock 50,000. And closing stock. Closing stock overvalued by 20,000. Let me assume it as 70. It is 10 lakh 70. 10 lakh 70. Which side is having highest amount? Credit side. So 10 lakh 70 minus all these expenses. 8 lakh 70 is the gross profit. So the overvalued, if I consider only the closing stock 50,000, how it will affect? Let us look into this one. Debit, credit, by sales 10 lakh, closing stock 50,000 to purchase 1 lakh, to wages 50,000, to opening stock 50,000. Now let us calculate this one. It's 10 lakh 50,000. 10 lakh 50,000. What is the profit now? 8 lakh 50,000. 8 lakh 50,000 is the gross profit. As you can see here, this is the original profit. What is the original value of the closing stock? It is 50,000, but it is overvalued by 20,000. 50,000 plus 20,000 is 70,000. If the clothing stock is showed more than the real value, it will have an positive effect. It will result into increase in the profits. As you can see here, the gross profit that we have got is 8,70,000 here. It is 8,50,000 here. So if the closing stock is overvalued, the net profitability or profitability will increase. So how to consider this one in the valuation of goodwill? It has to be deducted. It has to be deducted in the valuation of goodwill or calculating the adjusted profits. I hope you are understanding. Whenever there is an overvaluation of closing stock, it has to be deducted from the net profit so that we can get the real profit. Based on this one, let us calculate one problem.